What if I told you that every modern economy from the richest nations to the poorest is quietly controlled by a hidden mechanism that almost no citizen ever sees, and fewer still understand? Because here's the mystery. Every country on Earth is in debt. Not just some, not just developing nations. All of them. And yet the world keeps running as if this impossible math equation somehow balances itself out. But behind that illusion lies a system, a mechanism built over centuries, shaped by wars, bankers, politicians, and a handful of quiet decisions that shifted the fate of nations. A mechanism that silently dictates whether your currency is strong, whether your government must borrow, and why your cost of living keeps rising even when your income doesn't. Tonight, we uncover that mechanism. Before we dive into modern debt, we need to step back, way back, to a moment when debt wasn't a global system, but a survival tool. In the earliest civilizations, debt was simple. A farmer borrowed grain, a merchant borrowed silver. If they couldn't pay it back, they worked for the lender. Debt was personal, tangible, limited. But everything changed the moment rulers realized something. Debt wasn't just a financial agreement, it was a tool of control. Ancient Mesopotamian kings wiped debts clean when people got restless. Not out of generosity, but because too much debt caused revolt. Too much revolt threatened the king, and a king without subjects had no kingdom. Debt resets became political survival. Fast forward to medieval Europe, merchants facing long-distance trade needed a new tool. Precious metals were heavy, dangerous to transport, and limited, so they created bills of exchange, early IOUs that traveled safer than gold. Then came a turning point that shaped everything. Banks realized they could issue more notes than gold they actually held. The world's first version of money from nothing was born. Jump ahead to the 1600s. Nations were growing, armies needed funding, and wars were expensive. Kings were constantly breaking. Taxation wasn't enough. So governments turned to an idea that would rewrite economic history. Why not borrow from the public? The Dutch pioneered government bonds. England perfected them. Soon, nations everywhere copied. But here's where the mechanism began to take shape. 1. Governments issued bonds to borrow money. 2. Banks bought the bonds. 3. Banks used those bonds as collateral to create more money. 4. That newly created money flowed back into the economy. 5. The economy grew, which encouraged more borrowing. A self-reinforcing loop. For the first time, national debt wasn't a burden, it was fuel. If the system kept growing, it worked beautifully. If it ever stopped growing, everything broke. And that single condition, perpetual growth, became the quiet requirement baked into the machine that controls modern economies. The next major evolution happened when governments realized they needed a central authority to control money, credit, and interest rates. Enter the Bank of England, the Federal Reserve, the Reichsbank, the Bank of Japan, and every central bank that followed. But here's the twist most people still don't know. Central banks were not created to make life better for citizens. They were created to ensure that governments always had access to credit, banks always had liquidity, and the debt machine never stopped running. Every major central bank was designed as a stabilizer, not of the people's economy, but of the debt economy. They learned to control nations through interest rates, bond purchases, reserve requirements, money creation. These were not random tools. These were engineered levers, and as soon as central banks existed, debt became permanent. Debt became systemic. Debt became the backbone of modern economies, not a flaw, not a mistake, a feature. The mechanism was functioning smoothly until the 20th century delivered to world wars, global depression, and unprecedented destruction. The world needed rebuilding, but rebuilding required something the old gold-based monetary system couldn't provide: infinite money. In 1971, when the United States ended the convertibility of dollars to gold, the last restraint vanished. For the first time in human history, money was backed by nothing but government promises. Debt wasn't tied to gold. Debt wasn't tied to physical limits. Debt wasn't tied to reality. Debt became the raw material from which new money was created. And that's the moment the hidden mechanism snapped fully into place. 1. Governments issued debt. 2. Banks buy that debt. 3. Central banks guarantee that debt. 4. New money is created from that debt. 5. That money enters the economy as spending, loans, or credit. Every dollar begins as debt. Every euro begins as debt. Every yen begins as debt. Debt is the root, not the result, of modern money. But a system built on endless borrowing has one fatal flaw: it must grow, always faster, forever. Because if the debt stops growing, economies shrink, governments panic, banks freeze, markets crash, currencies destabilize, jobs disappear. and citizens suffer even though they never created the problem. Let's break down the fallout in the real world. 1. Governments become addicted to debt. Every election cycle demands new spending. Every crisis demands new stimulus. Every downturn demands new borrowing. Politically, debt is easier than tax hikes. Economically, debt is easier than cuts. And structurally, debt is easier because central banks make it easy. 2. Banks become gatekeepers of wealth. Banks create most of the money that exists today, not by printing, but by issuing loans. The more debt people take on, the more money banks create, the more profit banks earn. Your mortgage is not just a loan. It is a tiny gear inside the global debt engine. 3. Citizens become permanent participants. Wages rarely keep up with inflation. Inflation is baked into the system, and inflation is the result of money creation, and money creation comes from debt. So you pay for the mechanism not with taxes, but with rising prices. Every generation has tried to tame the debt machine. Gold standards, balanced budget laws, austerity, debt ceilings, fiscal rules, international lending controls, none of them worked. Why? Because these solutions fight the symptoms, not the cause. Modern economies require debt to function. Debt creates money. Money drives spending. Spending drives growth. Growth prevents collapse. Remove debt, and the economy melts. This is why debt ceilings always rise, stimulus never stops, bailouts keep happening, crises become more frequent, inflation is perpetual currency, devaluation becomes normal, wealth inequality accelerates. The mechanism isn't broken, it's working exactly as built. The problem is that it was built for stability of institutions, not prosperity of people. Look around the world today. Debt levels are reaching historic highs in country after country, not because of mismanagement, but because the mechanism demands expansion. Nations borrow more each year, corporations borrow to buy back shares, consumers borrow for homes, cars, education, banks borrow from central banks borrow from the future. Even when economies grow, debt grows faster. Even when inflation rises, debt rises faster. Even when interest rates climb, debt still rises. Modern data shows one repeating pattern. The global debt curve never declines, it only accelerates. This is the signature of a system that cannot slow down, because slowing down means breaking down. You're watching the same pattern that unfolded in the Dutch bond markets of the 1600s, in British Empire expansion, in post-war America, in Japan's 1990s bubble, in the 2008 financial crisis, in COVID-era stimulus, in today's global credit surge. Different eras, same mechanism, same outcome. So what exactly is this hidden mechanism that quietly controls every modern economy? Here's the simplest explanation. A system where money is created through debt. Debt requires constant expansion, and expansion is enforced by central banks, governments, and financial institutions that depend on the continuation of borrowing. It is a loop that feeds itself, a machine designed not to create prosperity, but to maintain motion. It rewards those who issue the debt, those who hold the assets, those who gain from inflation, and it punishes those who work for wages, those who save in cash, those who rely on fixed incomes. It is the quiet force beneath. Rising housing prices, shrinking purchasing power, government deficits, currency instability, widening inequality, financial bubbles, and constant economic emergencies. Once you understand the mechanism, you begin to see it everywhere. It's not hidden because it's secret. It's hidden because we were never taught to look for it. Takeaway 1. Debt is the foundation of modern money. Every currency today is debt-based. Every dollar begins as a loan. Every economic cycle depends on borrowing. Takeaway 2. The system requires perpetual expansion. If debt stops growing, economies contract. This forces governments and central banks to constantly intervene, creating long-term instability. The cause is structural.